The McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events.
So there is a degree to which destabilization, whether it is caused by us, supported by us, or whatnot, ultimately does solve this issue of how do we fund our deficits, how do we bring dollars into the Treasury market. With enough fear in the atmosphere, then guess what? You have buyers who say, I prize U.S. Treasuries, if only for one quality, this one quality, liquidity.
Now here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. We just, a few minutes ago, were watching a clip together, Dave, going back, you can see anything these days on the internet. We were just sort of reminiscing with Lucille Ball and Ethel on that famous scene when they were told to wrap chocolates, as they came along on the conveyor belt. Everything was going fine at first when they had control of it, but then they started getting out of control. That's when the humor started.
And of course, they couldn't keep up.
Yeah.
But so they had to do things to make it seem like they were keeping up, which, take chocolates off and just throw them away. That way the boss wouldn't know that they were missing any chocolates from the assembly line. But again, games can only be played for so long.
Why does this apply? It applies because we were talking about the Federal Reserve. In managing money, they were given two mandates for years. One of them was to control inflation. The other was employment. But there's a third mandate that's been thrown in that they'd love to think that they're keeping up with while they're wrapping that chocolate, wrapping the two things. But actually, that third mandate creates something that almost, in the end, has to lead to chaos.
Well, right. And something that you've taught me about from Newton's gravitational and force laws, that you can handle a two-body problem. But right. When you add a third variable, that's when chaos ensues.
That's right. Yeah. And for those who are listening who are not familiar with that, when Newton came up with his laws of gravity and force, it allowed people to understand from a mathematical way how two bodies would orbit each other. And you could make predictions hundreds of thousands of years into the future, and they'd be mathematically accurate. But if you add a third body, you add a third planet, let's say, to that, it almost always ends in chaos, and it's what they call a non-closed form solution. And, it's unpredictable. And with the Fed, going back to these three mandates, with the Fed now trying to control the markets and bring market stability to the first two mandates, it can't end well.
Well, after the March rate hike, the Fed still has two expected hikes this year.
Right.
And 3 total for 2019 as well, according to the Fed's forward guidance. That's what they're suggesting they will do. This week's market actions suggest that the Fed can, and in fact may have to find excuses not to act,
right,
not to raise rates the remainder of this year.
This has been your point for the last few weeks. How can they?
And if they do, it's going to be in light of a shift in sensitivity to market accommodation. Again, less sensitive now than in the past. For the last 30 or 40 years, the Fed has been very sensitive to market volatility.
Well, the question is, will Powell be different? Okay, is he different? We know that there are some guys, Bullard, who don't think they should raise rates, but will Powell be different?
We'll have to see, because March was the first indication that he doesn't mind a little bit of discipline. So he's bringing in rate increases and is not really concerned what the implications are. He's sticking to the discipline. So will the larger committee, the FOMC committee, maintain its disciplines and focus on inflation rates and unemployment? Or, as you're suggesting, is there going to be that third non-official mandate coming back onto the scene? Is it going to displace the other two?
Mm-hmm.
Again, a focus on price stability and unemployment. And again, what are they trying to do? It's an influence of public sentiment, and you do that via the markets by directly buoying prices within the markets through your purchasing of assets.
Well, or talking about it. This is something that's been interesting through the last few years. We've watched that the Federal Reserve, one person will say, yes, let's raise rates. And then they'll see what the market does. And then you'll have someone else come in and they'll say, oh, no. We didn't mean that. We really don't want to raise rates. Now, Bullard is the guy right now at the St. Louis Fed who's saying, don't raise rates.
Well, and I can't help but laugh at these days when I hear Trump say anything. He's saying something and he's saying nothing and he's saying everything. We are going to have a conference with the North Koreans. We're not going to have a conference with the North Koreans unless we do. And if we do, then we will have had one. And it's kind of like, well, What are you saying?
So
Exactly?
in a way, that's another three-body problem, but we can talk about that later.
It's on, it's off, but it could happen. And if it happens, then it happened.
Right.
And it's just, so you're right. Bullard over at the St. Louis Fed used to be very hawkish. And it's interesting because he has changed quite a bit. He's already suggesting more on the dovish side that no more rate hikes this year are warranted, that he's very concerned. He does not want to invert the yield curve. He does not want to send the wrong message to the market, because with an inverted yield curve, flat to inverted, and the market begins to say, hey, this is a precursor to a recession. And he doesn't want to say that. So he's saying, look, let's just pause here, do nothing. The implications of rising rates in the U.S. and a strengthening dollar, they're huge when you look around the world. And the Fed has actually claimed here in the last few months to have taken that into account. They're not concerned about the emerging markets. In their calculus, everything should be fine, both for the emerging markets and for the U.S. markets, when in point of fact, that's not happening. I mean, we've seen some chaos here in the emerging markets of late, and it does tie to a strong dollar. And so, I mean, what are they working with? They're working with math, and we might even criticize that it's merely math. Markets ultimately are driven by sentiment, and sentiment can overwhelm even the best efforts by the central bank community. And that's really what we've been seeing more of recently. And I think they have to be cautious. The Fed has to be cautious.
Well, I wonder if they look at history, because history shows if there's ever been a reversal of rate hikes, when we saw the rate easing over and over and over throughout history, but that is always reversed with rate hikes. It's almost always followed by some form of liquidity crisis.
Yeah, and it's rate volatility specifically, and most of the times the chaos comes from an increase in rates. Maybe going back to the 29 period, 37 period, there's some exceptions, but Michael Hartnett over at Bank of America Merrill Lynch, one of our favorite shotgun weddings of the last decade, he was using a recycled chart that I've seen before, but what he was underscoring was a very important point, and he said that every Fed tightening cycle creates a crisis, whether it be 1929, 1937, 1970, 74, 82, 87, 1994, 1997, the year 2000 or 2007, or even the present tightening cycle. When you have those tightening cycles, crashes occur. Mm-hmm. And he put it in axiomatic terms. When you have a tightening cycle, then you have a crash. I think what's critical to remember is that the implications of less liquidity in the system, which is essentially what is happening when you're raising rates, they're more acute in particular markets. And it's not universal, but you cause stress and strain in a particular market. And so it is some asset class in some geography which takes the biggest hit.
Right. So it's not always universally just a stock market crash here. It's somewhere.
Right. And it could be the debt markets. It could be the real estate markets. It could be the sovereign bond market. It could be the equity market. Those years, what we just mentioned, they led to U.S. bank problems in many instances. Mm-hmm. In many other instances, there was liquidity crises which emerged instead in places like Latin America and Russia and Asia. We had the U.S. S&L crisis, savings and loan crisis. It's a little like the game whack-a-mole. There's no question that liquidity tightening as a result of rising rates is a disaster for someone. Right. But the issue is whether or not you can hit the mole fast enough.
Right.
Hit the mole fast enough and hard enough, because the degree or severity of the next crisis relates to contagion.
And if you've ever played that game, and I have, you can watch somebody else playing and they can look like an idiot. It's like, I could do this. This is not that hard, and then you put your quarter in or whatever it costs, and you realize that you can't do it. That seems to be the case with, what the Fed does. They can control things that they think are in their purview, but you brought up Latin America, you brought up Russia, you brought up Asia. Right now we have the emerging market situation. Interest rates rising. They already owe us money in dollars, and interest rates are rising, and the dollar's rising. How's that going to go?
Well, and again, remember that the implications of any of those crises were the knock-on effects, the things that happened after the fact. So the Russian bond default, we had major implications here in the United States with long-term capital management and a collapse of a hedge fund, an overly leveraged hedge fund.
So it came home.
It did.
It came home.
In a very unexpected way.
Right.
And, the same thing in Asia, it became known as the Asian flu because it was spreading like a nasty illness throughout the whole region. So, the financial interconnectedness that makes this even more an issue in the modern era of finance. And I think time will tell which geography it is or which asset class is central in the context of the next crisis. But when the dollar strengthens, as you were alluding to, when the dollar strengthens or the euro weakens because of implicit issues in one or more of the member countries, you have capital which flows, and in this case, flows our way, and you basically have safe haven shifts. Okay,
but last week you brought up something that was just bone-chilling to me. I just couldn't get it out of my mind, and it had to do with us borrowing 80% of what the world saves. Now, we know that savings is what gives us resilience. How do bodies live for a long time? Well, there's some sort of savings in the bank physically for a body to be able to do that. And usually when a person gets old and ends up dying, it's because that bank is depleted. Well, it's the same thing with a company. Companies can go through an awful lot and they're resilient if they have savings. Now, if we're consuming or borrowing 80% of the world's savings just for us to survive, where's the resilience in that?
Yeah, so 80% of the global savings funnels into our country to counterbalance our current account and trade deficits. Right. At its root, this is simply overconsumption on our part combined with under-savings here in the United States. Because we overconsume, and that habit is enabled by the credit markets, you've got more products produced outside of the United States. They flow into the United States, right? And there's this difference between what goes out from us, again, produced products from us versus consumed products that come into us.
And that's where the trade deficit comes from that Trump is trying to respond to.
Right. And, doing some victory laps here recently with an agreement with China, the distortion that Donald Trump is trying to sort out with the Chinese is to shrink that current account deficit by $200 billion by 2020, which is the equivalent of saying that we're going to buy less from the Chinese and they must buy more from us to equalize the trade relationship and make it less import-centric into the United States.
But let me ask you this, though. Is this just China? I mean, we buy from other countries as well.
Yeah, the problem with that strategy, if we want to follow the logic of one of our commentary guests, Stephen Roach, who was former chairman of Morgan Stanley Asia and one of their chief economists for many, many years, and he's now a Yale Business School lecturer. The problem is that the trade deficit is not a bilateral problem.
It's not a two-body problem. Right.
In this case, last year we had a trade deficit with 102 different countries, not just China. China may have been one of the largest, but it was not the only one. If the Chinese say, fine, we'll stop selling product X, Y, and Z to the United States, that doesn't really help us, because bear in mind that products which we're sourcing in China today, we're sourcing them there due to the low cost of production relative to other alternative sources of manufacture and production, right? So shutting down the exports of $50 to $100 billion of products made in China, all that does is divert the sourcing of the manufacturing to a higher cost location.
Well, and it may be another country outside of the United States.
Right. Maybe one of the other 102, 101 that we have relationships with and run a trade deficit with. So by the time the product reaches our shore, the product which the Chinese have agreed, we're not going to produce this anymore, you can get it from someplace else. By the time that product reaches our shore, not only is the consumer paying more, and again, think about how critical this is, because that's the equivalent of a tax hike. But the trade deficit has likely grown in nominal terms due to larger dollar costs involved with that product acquisition. So by approaching the issue as the current administration has on a bilateral versus a multilateral basis, again, you got to address trade with the majority of your trade partners as opposed to just on a one-off basis. What you're basically doing, and what he's done, is move the jello around the plate, shifting production from one place, China, to other places, which unfortunately have sort of higher cost geographies. And implicitly, what that does, as I just said, it increases the price to the end consumer.
Yeah, in fact, you're increasing the price, but you're really not gaining the benefit on the trade deficit at all.
No. So no benefit on the trade deficit side, which was intended, and it does come as a high cost to the U.S. customer. So when I think of Peter Navarro and Wilbur Ross putting these things together, I wonder what they're looking at. I wonder what they're looking at such that they can miss the macro implications of what they're doing. Because again, it is a little bit like just moving Jell-O around the plate and pretending that it's no longer on the plate. It's still there. It's just not in one mass. It's in small pieces. Whatever. It's just they haven't accomplished anything. Well, if the trade deficit was the issue.
One of the open questions that we've had through the years is when we're not on the gold standard as a dollar, how do we maintain our legitimacy? When we're then no longer just the only petrocurrency, the petrodollar, how do we then maintain legitimacy? How do we continue to borrow the amount of money, this 80% of world savings? How do we borrow that money? How do we draw them to the dollar? Do we enjoy a little bit of the chaos that's being created right now in the emerging markets? I mean, are we enjoying some of the benefits of that by people fleeing to the dollar, not because it has gold, not because it's an oil-based currency, but it's seen as a stable currency?
You know, Kevin, if you look back at our foreign policy during the Cold War, one of the things that we were notorious for doing was destabilizing regimes. And it was better for us to work with someone who was insane and cruel, but in our pocket or in our hand and could be controlled. And we were willing to destabilize regimes to get that person in power. There was no sort of greater morality like, oh, you're supporting a bad regime, because we had a bigger battle at hand, and that was the fight of the Cold War.
And we were also breaking alliance bonds. In other words, you don't allow 2, 3, 4 countries to ally against you. You can pit them against each other.
Yeah. So, I mean, the fact that destabilization is to our benefit, that's not new for us. I mean, in this mess, you're right. How do we fund our deficits? How do we create an appetite for mass quantities of U.S. debt? Well, I mean, we entered the discussion on Italy because Italy's in a bit of chaos here in recent weeks. And to be frank, what is bad for the euro is good for the dollar. And is, if you want to sort of follow the domino theory, terrible for the emerging markets. What's good for the dollar is terrible for the emerging markets, which again is good for the dollar, driving foreign capital to U.S. treasuries on a safe haven bid.
We call it flight capital.
Right. So there is a degree to which destabilization, whether it is caused by us, supported by us, or whatnot, ultimately does solve this issue of how do we fund our deficits? How do we bring dollars into the treasury market? With enough fear in the atmosphere, then guess what? You have buyers who say, I prize U.S. treasuries, if only for one quality, this one quality, liquidity.
And that liquidity would be needed in this particular case because of problems that are brewing in a country that you've been bringing up on numerous occasions. Italy's nothing new. This has been on the radar.
Well, I think in our conversations, the question was, which of the two is a bigger deal and which will come to the fore first, Italy or Spain? The political chaos that we've seen brewing in Italy, it's been there for a long time. It's now coming to the attention of a global audience because prices are shifting and prices matter. I mean, this is like my dad. He's reflected on this. If you just don't care if a Starbucks is closing some shop somewhere in the world, until it's your Starbucks on your corner.
He does love his chai tea, doesn't he?
Oh, he's a chai tea fanatic.
Yeah.
So the bond market is drinking a bitter brew in recent days, Italian roast to be precise. And it's the Italian markets which are being repriced radically, and people are paying attention because it's in their portfolios.
Well, let's talk about the repricing. I mean, how do you know a market's being repriced? It's the interest rate that they have to pay to borrow money.
Yeah, Italian 2-year note yields have been up as much as 170 basis points. That's 1.7% in a matter of days, according to Bloomberg. And I know discussing numbers on the fly and having lots of them in our conversation can diminish the impact of them, but that is a massive liquidity tightening, which for the Italian financial sector is the equivalent of removing oxygen and still expecting everyone to function well, but do so in sort of an anaerobic, oxygenless state.
Is that more than when we had the global financial crisis?
170 basis point move in a short period of time is more than we saw during the global financial crisis. And it happened in a very brief window. So yields are now at levels in Italy last seen in 2012. The Italian 6-month bills, the shorter term paper, they've been offered in the last 3 auctions or sales, and they sold at negative yields of 41 basis points.
Because people are fleeing to shorter maturity? Is that what you're saying?
No, it's because there's a guaranteed win. The European Central Bank has been buying this paper to the point where you're willing to bet that the European Central Bank is going to buy even more and drive yields from negative to negative-er, if you can say it that way. But this week, by contrast, instead of at negative 41 basis points, they sold at 1.21%, or 121 basis points. So that's positive versus negative previously.
So they're having to pay more even for the short debt.
Oh, yeah. And that's a very big deal in terms of liquidity dynamics within the financial system, and that ultimately impacts how an economy functions.
Well, usually the Europeans look at things and they measure them against Germany. Okay, Germany is seen as the mothership. And, how does that balance then?
Yeah. In Europe, the German Bund is considered the sort of risk-free rate, just like the U.S. Treasury is here, and frankly, on a global basis, the U.S. Treasury is called the risk-free rate. Mr. Tactical Short, Doug Noland on our team, pointed out that spreads between the German Bunds, the equivalent of our treasuries, and all of your other European paper, they're widening. So again, you've got the interest rates shrinking for the Germans and increasing everywhere else, the gap between them, that spread, widening, and we're also seeing that in U.S. Treasuries as well. We were at 3.08 on the U.S. 10-year last week, and it has since retreated to 2.87%.
Because they're moving into Treasuries. We don't have to pay as much to get people to. This is what we were talking about. Chaos elsewhere is going to drive money into the dollar, at least temporarily.
Right. A 21 basis point swing might not sound like very much, but in a market as large as the U.S. Treasury market in the 10-year, where there's plenty of volume in the 10-year trade, somebody likes liquidity. Someone is saying, I prefer liquidity. And when people start prioritizing liquidity over anything else, it does tell you something about a significant shift that's taken place in sentiment. The U.S. Treasury market still offers that primary benefit, liquidity.
One of the things we saw before the global financial crisis was bad debt was being called good debt. And banks have to hold certain good debt, whether it's AAA rated or whatever you want to call it. They have to hold that on their balance sheet. But when you call bad debt good debt, when Standard & Poor and whoever the rating services are start getting sloppy and giving good ratings to bad debt, it ultimately catches up. And that's what happened in 2008. Now, in Europe, I've got to think that some of these Italian bonds are in the bank accounts of some of these large European banks.
Well, they are, not just in the bank accounts, but on account as in the reserve assets of the banks. So Tier 1 capital, sort of the top of the heap, the best quality capital of the bank. Your largest Italian banks hold individually 10 to 15 billion euros of that paper, which is the equivalent to 150 to as much as 200% of their Tier 1 capital. And it's an issue. It is an issue for the banks because it implies this. Price volatility on the scale that we're seeing in the Italian bond market is sufficient to flip an institution from solvent to insolvent overnight.
They'll never see it coming either because they're calling it good capital.
That's right. In the U.S. market, if someone's sitting on a boatload of treasuries, they'd say, well, of course, this is our best collateral. This is our very best collateral. What happens if your very best collateral loses 20 to 30% of its value overnight? Then all of a sudden, you have collateral calls, capital calls. You have the equivalent of things that lead to insolvency. That's why it matters. And again, in a world of interconnected finance, it's always good to know who is and who isn't solvent. But more than that, you've got Italian bonds and other European peripheral paper that has been one of the best investments. Think about this. It's been one of the best investments. And again, this is one of the craziest things for me to rationalize, but it's been one of the best investments since 2011. And I can't help but think of the moth to flame analogy, where you've got high rates of return, which attract lots and lots of investors. This is the bigger issue. The bigger issue is that you've got in the Italian bond market several $1 trillion in debt outstanding, and it's being rapidly repriced which is more than inconvenient for European investors and for other investors around the globe who, again, have basically said nothing's going to happen here. Mario Draghi has promised, he's given us a guaranteed positive rate of return.
Oh, he's been a buyer of first resort. You brought that out last week. A buyer not of last resort, but of first resort. He's the first one waiting at the door when the Italians open it up to borrow money.
Well, and it's just fascinating to me that you can have an element like that, which is the defining element in the pricing of a market, which becomes irrelevant very quickly. Yes, Draghi has forced interest rates down across Europe via the bond purchases that he's been involved with and orchestrated. And the ECB has given the proverbial free lunch for investors, and those investors have been hopping on the European debt investor bandwagon. They've been doing that for a couple years now. And it actually turns out that the lunch is not really free after all. Markets are not just a one-way bet. And again, that defining element in the market, as powerful as it is in the short run, in the long run, does not have the sort of efficacy that they believed it did.
Well, is it just countries and just the European Union, or is it actual corporations that are also holding this?
This again goes to the idea of contagion and the idea of cross-exposure. BNP Paribas in France has been a major buyer of Italian debt. Dexia is a Belgian bank, another big buyer. And then, of course, you've got hedge funds, institutions, individual investors that have held on to some sort of a belief like, lightning never strikes twice in the same place. Mm-hmm. And, in spite of the fact that they've seen the Greek crisis recycle like a scratch on a record. I mean, that it's only a matter of time before, whoops, we got to go again. Whoops, here we go again. Whoops, here we go again. And somehow Italy was going to be different. So, I love dark coffee. Love dark coffee. And some actually have given me this critique. You have an underdeveloped palate. Don't you know that dark coffee beans are over roasted? They're burnt, or that's the argument that they hold up to me. And Italian roast is up there near the most toasted. Maybe French roast is the very most.
But you can get to bitterness once you get to a certain amount of toasting.
And that is what's not to like this week in the Italian bond market, because the Italian bond investor is tasting the extreme bitter aftertaste, losing money on what Draghi gave the impression was a guaranteed win, a guaranteed bet.
Dave, we're going to go back and play archived shows in a few years, and we're going to say this central bank control, this guaranteed bet in the markets that we always knew the central banks had our back. We're going to look back and we're going to say, it didn't work. It didn't work. It's just like, again, going back to Lucille Ball, packaging those chocolates. It works for the first 30 seconds or so when you watch the clip. In fact, let's attach that clip just for fun. It's a couple of minutes. Everybody can go back and remember what it was like. But we're going to look back and we're going to go, that chocolate scene is exactly what happened to the central banks, not just in the United States, but worldwide.
I think it's worth mentioning that on a routine basis, you've got the idea of the central bank community rigging the markets. And that's often used as an excuse to sort of stay the course in your investment themes, whether it's as a stock investor or a bond investor. And it's kind of like a blanket version of the quote, I'm sure you've heard, don't fight the Fed. Let's include the Bank of Japan and the ECB in that. But they have the equivalent of superpower strength, and they alone direct and control prices. And I agree. I certainly agree that prices can be pushed around and influenced in the short term. And European debt would have to be exhibit A for that. And we've seen that over the last few years. But my main point is this. My main point is look at the Italian situation and note that as the third largest economy in Europe and a linchpin for the success of the Euro project, the ECB can no more control the pricing of that market than they can direct the weather from one day to the next. So again, if you're concerned as an investor about the markets being permanently rigged, know that the powers that be are not capable at scale and over a long duration of doing so.
Well, it's what we talked about before. Okay. People are treating this as a two-body problem. They're saying, you know what? This is going to go on, not just for hundreds of years, thousands, hundreds of thousands of years. Those two bodies, we can mathematically predict it's controlled. The problem is there are more bodies at work here, and it goes to chaos.
And we're not talking just about price stability and unemployment, which is what the central banks of the world have generally fixated on. But when you bring in controlling prices in the marketplace, not just in the currency, but when you start trying to influence market sentiment and the market buyers and controlling activity in the economy through controlling asset prices, that's an issue. I mean, ultimately, if you wanted to step back and say, can you kill the market? Can you have the powers that be ultimately dominate and control? The answer is yes, there is a way, but that is to kill it. That is to nationalize it. But that's a different issue. Italy is, to me, it's refreshing. It's refreshing not because I delight in the pain of others. This is not sort of schadenfreude, but because this is a reminder that the markets count votes and the votes in.
It's a little like when volatility started to come back in the market here. It was hurting people's portfolios, but it was refreshing because we actually saw that the markets are still alive.
Right. And this is the way it should be. Italy has so much political confusion and chaos that economically the path ahead is no longer clear. And therefore, a bet in the financial markets of Italy is a bad one, right? So that is a reasonable process to go through. Again, political confusion, economic non-clarity, financial market abeyance. You just step back and say, I don't really know what to do. I'm just not going to engage. I want my money back. Return of versus return on capital. That's in play in Europe. And this is good to see because it reflects lack of control by the central banks and a return of control by market participants, the voters.
Didn't we see volatility, not market volatility, but voting volatility enter the U.S. markets a couple of years ago during the Trump election? Okay. So what we saw was there was the group of people who felt like this was completely controlled. They're still looking back wondering what happened to them. Okay. But volatility changed the day.
I think ultimately the Italian issue is an echo of the U.S. election in 2016. You know, you've got a new prime minister just announced in Italy, and the government is going to be organized around the Five-Star Movement. Five-Star Movement is this ragtag populist group which is completely upset all the established powers and political structures in Italy. It's fascinating to watch.
Do you remember what you were talking about in 2016 when you were asked to speak in South Africa at the Economic Forum? You were talking about the reversal of globalization.
Right. Big theme was the reversal of globalization. There's an economic forum in South Africa, summer of 2016. And the argument at the time was that there was a growing populism and nationalism that was reversing the priorities of globalization. And there was a period of time where everyone was making money and it was very easy to sort of define yourself as a good global citizen. Or if you lived in Europe, then you were actually more European than you were Italian or French or German or what have you. And again, that's in good times. That works. When things begin to move in reverse, when you encounter economic imbalances, then you've got the mass of people who are at odds with that broader vision, right? So you had the upsurge of Syriza in Greece. You had the Five-Star Movement in Italy. You had National Front in France. You had Podemos in Spain. Brexit was an expression of this in Britain. And of course, this fight between Trump and Sanders here in the U.S., they're all telling us that political volatility was on the horizon and it was everywhere. So that was one of the main themes that I wanted to hit at the economic conference in South Africa. But this is why the Italian problem can't be resolved overnight. The root is not financial. The root is not financial. Yes, there's financial implications. Yes, we're talking about financial banks and assets and things like that. But the reason why you're seeing a repricing of those assets is that investors are having less clarity on what it means for Italy to be governed. And will Italy be governed in the context of the euro? And what are the larger implications for the euro if Italy, under a populist movement, is no longer a part of the euro? I mean, so there's bigger questions, and again, it ties to politics. The implications are in the financial markets, but the root is in politics.
Well, and when you're talking about politics, you're talking about perception. You're talking about sentiment. And we've talked about how the Federal Reserve, you know, you've got Powell coming out and saying we're going to raise rates. You've got Bullard coming out and saying, no, we're not going to raise rates. We've seen sentiment and perception actually managed now for years. And if you've ever been part of a group or a club or a family where something's going terribly wrong, but perception's being managed by only what's being said, that only lasts for a season. You'll have the people who are loyal to the people who are trying to manage the perception. They'll go along with it. But when it starts hurting, when it actually starts hurting the wallet, or worse, that's when the perception breaks down. This is what you're talking about. Italy is starting to show this is another sign that the sentiment is changing.
Albert Hirschman wrote the book Exit, Voice, and Loyalty. I think I've mentioned it a number of times in the commentary.
Good book.
And I would say that, in line with Thomas Kuhn's The Structure of Scientific Revolutions, this is one that you need to know. You need to have read it, studied it, underlined it, and cross-applied it into a variety of different areas. Because just like Kuhn applies sort of into a variety of places, whether it's literary criticism or the history and philosophy of science or what have you, so Exit, Voice, and Loyalty deals with issues that are both relating to corporate structures as well as national and political structures as well. And I can't recommend it highly enough. I think you'll see what's happening in Europe from a very different perspective and begin to appreciate also what happens in the financial markets when participants are given three basic choices. Again, loyalty, as you just framed it. Ignore the problem and just, according to a party line, go forward. Give a voice to it and say, hey, wait a minute, this isn't working for me. Or quietly disappear into the night. Mm-hmm. And the exit function is what you begin to see when a market tide shifts, right? And people just say, no, I'm out. I'm gone. I opened the presentation down in South Africa with 3 quotes. And I think I'd like to end our conversation today with those because I think it's healthy. Rudiger Dornbusch, contemporary economist, says that in economics, things take longer to happen than you think they will. And then they happen faster than you thought they could.
Good quote.
And then Lenin, because I'm such a fan.
Your dad loved to quote Lenin because he hated communism. But Lenin actually said some very true statements.
Here's Lenin putting 10 pounds of mud into a 5-pound sack.
Right.
There are decades where nothing happens. And there are weeks where decades happen. And so to begin to see some of the volatility like we've seen in Italy, and I think ultimately the question is the severity of the next crisis, where does it begin? And are they able to contain it such that it does not spread? There are decades where nothing happens, and there are weeks where decades happen.
Well, and I think your third quote comes from a good friend of ours who passed away over this last year, Ian McAlvany.
Well, and it ties to the populist theme, which is when times get tough, economic nationalism and protectionism tends to rise because it's always easier to blame someone else for self-inflicted problems. And you're right, Ian was a savvy guy, but the game of whack-a-mole, should the game of whack-a-mole get out of hand and these fingers of instability spread beyond Europe, I return to a very simple, but I think timely allocation prescription, which is number 1, have sufficient liquidity to matter. Have enough cash to matter. Okay. And secondly, hedge your long positions so you don't take any big hits. And third, and maybe I should reverse 2 and 3 just in order, but the third is to hedge your liquidity with sufficient precious metals to offset any accrued losses which you may generate from the central bank maneuvering and devaluation, which is guaranteed to occur. So, again, have sufficient liquidity, hedge your liquidity, and hedge everything else that you have, because, again, in a period of difficulty and turmoil, this is not to say sell everything that you have and be 100% in cash and gold. There will be some who opt for that. But I think make sure that you're protecting the downside. If you have legacy positions, do what you can to protect the downside in those. Keep sufficient liquidity and hedge everything with a financial asset which is outside of the financial system, not in the daisy chain of obligations and debt liabilities, which virtually everything else is today.
You've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. You can find us at McAlvany.com, and that's McAlvany.com, or our phone number is 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.